guys, this is Michael from Nomadic Insights. In today's video, we're going to be talking about taxes you're going to face as a digital nomad or as an expat. These taxes come in three different forms. You have income taxes, business taxes, and then pension or social security taxes. If you have any questions about the content in this video, feel free to leave us a comment below or join our Discord community, Nomadic Insights, which you'll find linked in the description below. And as always, I invite you to attend our weekly live stream on Sundays at 11 a.m. EST, where we dive into different myths and ideas of living your life globally. Thanks so much. Let's dive into it. As a digital nomad, you need to be very conscious of your citizenship. There are two tax regimens based on how you're taxed on your worldwide income. There's residence-based taxation, which covers every country except the United States and Eritrea. And then there's citizenship-based taxation, which taxes you on your worldwide income based on your citizenship. The United States is the only major developed economy that's going to tax you on your worldwide income, regardless of your residence in other countries. So for Americans, you have ways of reducing your U.S. tax liability through double income tax treaties in countries where the United States has a tax treaty, such as Austria, Spain, Germany, Cyprus, and China, and even Canada. But for most cases where you're not covered by a treaty or the foreign earned income exclusion, more on that in a second, you'll be liable for taxes on your global income at these rates. Now, there is one major way you can reduce your income as a U.S. expat or digital nomad called the foreign earned income exclusion. The foreign earned income exclusion allows you to exclude a housing allowance as well as your income as long as you're outside of the United States for 330 days plus a year. You can only spend 30 days in the United States, after which, if you spend more than that in the United States, ipso presto, you are liable again for these lovely US income tax rates. Now, you need to be very careful with this when you make the foreign earned income election. You're only going to qualify for it after 5 years. So if you pick it 1 year, then you come back to the United States, then you decide to become a digital nomad again or become an expat again, no foreign earned income exclusion for you. So you need to be very, very careful when you elect to use the foreign earned income exclusion. Now, for people who are from the United Kingdom, Australia, you have a much simpler way to avoid taxes from your home country on your worldwide income, since you're taxed based on your residency. So if you're resident in a country with no income taxes, like Dubai, for example, you're not going to owe any taxes to the United States, to the United Kingdom's government, or to Australia's government, so long as you're resident in the UAE. What that means generally with a residency test is that you spend more than 6 months or greater than 183 days in that country. Once you're in a country for over 180 days, you're in with dual residency taxation. And some countries like Spain are notorious for going after people who establish dual residency. So this is something you really want to be careful of, and make sure you plan out your visits if you're trying to reduce your global tax burden, since you're gonna get hit by a wonderful tax surprise if you're not careful. Oh, and then next, for Americans, we have state taxes. And some states like California are notoriously difficult to de-establish residency from. If you don't have another permanent residence, you could be on the hook for California income taxes, which could add an extra, I think 13.5% to your tax bill. Or in my state of Connecticut, you could be liable for taxes up to 7% if your income is $500,000 or more as an individual filer. So you need to be very careful about managing your residency with local and state governments. For example, in Spain, if you're on the Padrón Municipal in a city, lo and behold, that's how Spain considers you resident and tracks it. So if you don't come off the Padrón, say hello to Hacienda and a big tax bill just for you. So again, you need to be very careful when planning out your exit from your home country, and you need to begin with an idea: is this travel permanent, or is it going to just be for a few years? Since once we go into things like the taxation of your pension, things can get really difficult for you. So first, let's focus in on Social Security taxes. For those living in other countries or from other countries like the United Kingdom, these would be your national insurance contributions or your pension contributions. For those in Canada, most countries have a Social Security system at this point. Your taxes generally consist of two things: payment into the national health insurance system for when you're older as a pensioner, and then taxes like Social Security, which give you a pension payment or annuity depending on where you're from. In the United States, these taxes total 15.3%. 7.35% is paid by your employer, and another 7.35% is paid by you as the taxpayer. These taxes cover your pension and then Medicare taxes for Americans. There's no way to avoid these taxes, even if you're claiming the foreign earned income exclusion as an American, unless you're covered by a Social Security tax agreement in your country where you live as a resident. So for example, I lived in Spain and I inevitably was covered by the Social Security system in Spain. This allowed me to avoid U.S. Social Security taxes since there's a totalization agreement between Spain and the United States. There are only 30 countries that have these totalization agreements in place for Social Security payments. It's really important, if you intend to collect Social Security and not have an entirely self-funded retirement, to pay these taxes and make sure your credits are accurate. For Americans, if you become disabled while traveling abroad, if you have 10 years paying in or 40 work credits with the Social Security Administration, at least you can collect Social Security income disability insurance anywhere in the world, or at least file for it in the United States. It's really important to pay these taxes. If you do not pay them, you will not be part of your home country's safety net and you'll have no benefits. This is one of the major cons of becoming a digital nomad. You need to make sure you're covered by a country's safety net. Since Social Security is still country specific, there's no global alternative. I highly want to stress it's incredibly critical to think about disability as a digital nomad. 1 in 5 people before the age of 65 will be confronted by a long-term disability. This is something you need to pay for with your Social Security taxes, or making sure you're still covered by your home country's system for disability. Generally, you need a certain amount of credits to qualify for disability coverage. For most people in the United States, their net worth comes from one of two sources. Source number one is the value of their home, and then the value of their retirement accounts. Countries have a way of taxing accounts differently. So in Spain, there is a wealth tax, and there are other countries in the EU and globally that levy wealth taxes. Your retirement account balances might not be subject to taxation in the United States, but those balances could be subject to wealth taxes in your new country of residence. It's very important to think about these assets and these questions of, will my retirement accounts be subject to taxation in my new home country? because it's not covered by the dual income taxation agreement. Generally, these agreements cover public pensions, where if you're a public worker, that public pension will only be taxed in the country of origin. But things like US 401ks as well as IRAs can be a really legal gray area when it comes to issues like wealth taxes. And then you need to also consider, if you own real estate, what are the real estate taxes on long-term capital gains? How do the tax treaties deal with that? And then what is the tax you might need to pay on potential rental income? Oh yes, if you own property in Spain, there's a tax on theoretical rental income if you're not in that property full time. Wonderful, I know, right? So these are the issues you need to consider while doing your taxes. As great as international tax experts are, if you're making under $500,000 a year, or you're not a high income individual with a high net worth, the expense of these services could put them beyond your reach. Again, do your own homework and make sure you understand how to do your taxes. For a lot of people, it might be simpler to just pay your US taxes, keep a US residential address, and just be a paper American resident, since it's much simpler to file under a US regimen and just keep your residency there if you're a digital nomad, since there's a lot of headaches that go into being a long-term traveling expat. It's gotten better, but in a lot of ways it's gotten worse, especially for Americans because of FATCA. You need to be very careful. There's a bunch of other reporting requirements like FBAR, which is if you have over $10,000 in a bank account that you're the beneficiary of. It just gets really crazy. Again, if you have any questions, feel free to join our Discord community and we'll see if we can help you out. Thanks so much, guys, and I hope you enjoyed this video on taxes from Nomadic Insights. Thanks so much and have a wonderful day.